This is a revision of audit, advanced audit assurance for the exam period March 2020. Marking scheme, question 1. A. Audit risk evaluation, up to 3 marks for each audit risk unless indicated otherwise. Marks may be awarded for other relevant audit risks not included in the marking guide. Okay. Half mark for relevant trends or calculations which form part of the evaluation of audit risks. Materiality calculation should be awarded 1 mark each. Annual incentive scheme, legal case, group finance, director's attitude, Dario code, local accounting rules, Dario code, possible impairment, reliance on component auditor, post-year acquisition of mission code, transient revenue analytical review, revenue recognition, amortization of license. B. Evaluation of Negan Associates audit strategy, up to 1 mark for each issue evaluated. Materiality. Using asset as basis for materiality is appropriate in some circumstances. Materiality should not be based on assets alone. A materiality based on a normalized profit could be used. Unlikely that higher level of materiality is appropriate given company's loss-making status. Full documentation is needed on how materiality is determined. Payroll. Further procedures necessary given the materiality of the payroll. Requirement of ISA 600 that same ethical guidance should be applied. Self-review threat from Negan Associates, providing the service explained. The service should not have been provided due to Dario Code's listed status. Sales of property. The transaction should be disclosed in group accounts and is material by nature. No consideration of whether the profit on disposal has been properly determined. Risk that transaction is subjected to bias given the company is loss-making. Property might not even have been sold, could be window dressing. No procedures to confirm an asset has been removed from the financial statements or on the recoverability of the amount outstanding. Conclusion. Audit quality. Audit procedures on sales of property. Review board minutes to see if the property sale has been discussed and formally approved by the company's board. Agree the $50,000 sale price to the legal documentation relating to the sales of the property to the group CEO. Confirm the book value of the property at the date of disposal to underlying accounting records and non-current asset register. Confirm that the asset has been removed from the company accounts at the date of disposal. Obtain management's determination of profit or loss on disposal. Reperform the calculation based on supporting evidence and agree the profit or loss is recognized appropriately in the company's statement of profit or loss. Obtain an estimate of the fair value of the property, for example, by comparison to the current market price of similar properties. Obtain written representation from the company management that all matters related to this related party transaction have been disclosed to the group management and to group audit team. Obtain written representation from the group CEO regarding the transaction to confirm the amount which is outstanding and the likely timescales for payment. Review cash received after reporting date to confirm whether or not the $50,000 has been received from the group CEO. See Joy Audit. Up to 1 mark for each relevant point discussed. Justification in favor of Joy Audit. Retain local auditors' knowledge of company, local auditors' knowledge of local regulations. Atlanta can provide additional skills and resources. Cost-effective. Reduce travel expenses. Local firm likely to be cheaper. Enhance audit quality. Possible disadvantages of dual audit. Employing two audit firms could be more expensive. Problems in allocating work and determining responsibility. Audit liability issues. Recommendation. Question 2. Part A. Fraud. Cannot determine whether fraud is immaterial without obtaining further evidence. Insufficient to rely on the conversation between Group Finance Director and the alleged fraudster as the source of evidence. Group Finance Director could be involved in attempting to conceal the true extent of the fraud. Audit team needs to use professional skepticism in relation to assertions made about the fraud. Financial statement could be materially misstated. Group Finance Director refusing to adjust. Auditor should consider reporting responsibilities to management such as with governance. Potential to report externally after taking legal advice. Consideration of client confidentiality. To sufficiency and appropriateness of audit evidence. Further actions, further evidence to be obtained. Development cost of material and the audit work performed is insufficient to determine whether research costs have been inappropriately capitalized. Intangible assets could be materially overstated and profit overstated. Agreeing amounts to invoices does not confirm the nature of expenditure. Arithmetically checking the spreadsheet does not provide assurance on assumptions which underpin the projections. The Group Finance Director refusing to allow full access to the spreadsheet increases risks. The audit team should apply professional skepticism. Attitude and actions of Group Finance Director should be discussed with those with governance. Reliance on a written representation is not appropriate. Further evidence. Trade receivables. The specific trade receivable is material and the audit work performed is insufficient to determine whether an allowance should be recognized. There is an audit risk that trade receivables are materially overstated and profits overstated. Agreement to invoice and including in a circularization does not provide evidence on recoverability. Discussion with credit controller provide background, but is not robust source of evidence. Further evidence. B. Critique of draft auditor's report. Combination of opinion and basis for opinion. Paragraph does not appropriate. Headings not correct should be qualified opinion and basis for qualified opinion. Qualified opinion paragraph wording is ambiguous and needs clarification. Basis for qualified opinion paragraph should contain further details on the rationale for the auditor's opinion. Explanation of proper use of emphasis of matter paragraph. Fraud is immaterial and not fundamental to users' understanding. Not professional to mention fraud in the auditor's report. Difficulties in the audit should be reported to those charged with governance, not to the shareholders in the auditor's report. Unprofessional and possible libellous wording used in relation to the Group Finance Director. Not appropriate to mention resignation in the auditor's report. Should be discussed with those with governance. Question 3. Lavenza Code. Matters to consider before accepting the review engagement. Intended use of the cash flow forecast, distribution of the information period covered by the cash flow forecast and key assumptions used, scope of the work, resources and skills, client integrity, ethical methods. Examination procedures on cash flow forecast. Cast the forecast to confirm accuracy, confirms consistency of the accounting policies with those using last audited financial statements, agree opening cash position to cash book and bank statement. Discuss key assumptions underlying forecast with government. Analytically review cash flow trends comparing with historical data. Agree discount and parity terms with customers and suppliers to agree contractual documentation. Agree to purchase ledger payments to confirm that the discounts taken and penalties paid. Agree average collection and payment periods to recent sales and purchase ledgers. Recalculate patterns of cash flows based on management assumptions. Perform sensitivity analysis varying key assumptions. Agree salaries to latest payroll records. Obtain and review breakdown of overhead costs. For sample of overhead costs, reviewing supporting documentation. Obtain and review budget and analysis of costs to date for new shops and marketing campaign. Review board minutes for discussion of new shops and marketing campaigns. Review outcome of the previous management forecast. Assess competence and experience of preparer forecast. Discuss possible cost options with preparer, finance costs, capital expenditure, tax payments. Obtain written representations from management. Request confirmation from the bank of potential terms of additional finance to confirm the interest rate. Consider whether finance chart in forecast cash flow appears reasonable.